I want you to picture a room most people never think about. It is not a trading floor with flashing screens. It is not a boardroom. It is not a glamorous technology conference where everybody tells you the future belongs to them. It is an auction room. That is where this story begins. And that is where most fortunes are quietly protected or quietly ruined. When I was younger, people liked to talk to me about stocks because stocks were exciting. They moved every day. They gave reporters something to shout about and neighbors something to brag about. But I learned a long time ago that if you want to understand whether the financial world is healthy, you do not begin with the loudest room. You begin with the room where debt gets sold. You begin with the bid, because a stock market can lie to you for a surprisingly long time. An economy can lie to you for a while too. Governments can lie to you almost indefinitely. But an auction has a way of forcing honesty. A seller shows up, a price is named, real buyers decide whether they want what is being offered. And if fewer buyers raise their hands, the seller has to sweeten the deal. That is not politics. That is arithmetic. Right now, the arithmetic is telling a story most investors still do not understand. The United States has to refinance an enormous wall of debt over the next year, not in some abstract future, not someday. Now, at the same time, foreign official holders have been cutting Treasury holdings held at the New York Federal Reserve. The number in your source was roughly $82 billion gone since late February, bringing those holdings down to the lowest level since 2012. That is not just a headline. That is the kind of movement that tells you the automatic buyer is becoming less automatic, and the timing is what makes the whole thing dangerous. The oil shock did not arrive in a vacuum. The war pressure hit, energy prices jumped. Countries that import oil suddenly needed more dollars, and when countries need dollars fast, they do not write OPDs about monetary theory. They sell what they can sell. That is the first thing I want you to understand. A Treasury bond is not only America's debt, it is also someone else's liquid reserve. If a country has to defend its currency, pay for more expensive energy, or raise emergency dollars in a hurry, it can dump treasuries. It does not matter whether the long-term strategic case for owning treasuries still exists. Urgency beats theory. Cash needs beat reserve policy. Pressure makes sellers. That is how a bond market begins to send a warning before the stock market even knows what question to ask. I have spent enough of my life watching debt markets to know that the first visible crack almost never looks dramatic enough to the public. It rarely arrives with a brass band. It looks like a small rise in yields, a weak auction, a few buyers stepping back, a headline most people forget in 6 hours, then it happens again, then again. And eventually you realize you are not looking at a one-off event. You are looking at a changing bid. That is the mother line of this entire story. The bid is changing. Most people think a debt problem begins when a government cannot borrow. That is too late. A debt problem begins when borrowing is still possible. But every new auction requires a little more bribery than the last one, a little more yield, a little more compensation, a little less trust. That is the phase we are entering. I want to make this plain because simple things get hidden behind complicated language. America does not just owe a lot of money. America owes so much money that the interest on the debt is becoming one of the biggest claims on the future cash flow of the country. When debt is small, higher rates are an inconvenience. When debt is enormous, higher rates become a machine that starts feeding on the budget itself. You refinance old cheap debt at higher yields. That raises annual interest cost. Higher interest cost widens the deficit. A wider deficit means more borrowing. More borrowing means more supply. More supply needs more buyers. If buyers are hesitant, yields rise again. That raises the next refinancing bill. That is not a theory, that is a spiral. The reason people miss spirals is that they expect them to look violent from the beginning. Most spirals begin as a sequence of reasonable adjustments. That is why they are so dangerous. Every step can be explained. Every step can be defended. Every step sounds manageable in isolation. It is only when you zoom out that you see the whole shape. This is what I call the rollover trap. The rollover trap is what happens when a nation becomes so dependent on refinancing old debt that it starts serving the market instead of the market serving it. A healthy borrower goes to the auction room because debt is a tool. A trapped borrower goes to the auction room because debt is oxygen. That is a very different posture. When more than a trivial amount of your national energy is going into paying interest, and when a large chunk of your debt stack has to be rolled at rates far above the ones you enjoyed in the last cycle, you are no longer talking about ordinary fiscal management. You are talking about dependence on continuous buyer confidence. And confidence is the most perishable asset in finance. Confidence does not disappear all at once. It gets shaved. First, a few foreign buyers diversify away, then a few auctions come in soft. Then the long end of the curve refuses to behave the way textbooks say it should. Then analysts start using phrases like structurally higher term premium. Then politicians begin demanding lower rates for reasons that have nothing to do with long-term monetary health and everything to do with short-term financing pain. And all the while the stock market still gives people enough green on the screen to keep them from asking the deeper question, who is going to keep buying all this paper at these prices? That is the question, who is the marginal buyer? I have made a fortune in my life by paying attention to the marginal buyer and the marginal seller. I do not say that to impress you. I say it because whole worldviews open up once you understand that prices are not set by average conviction, they are set at the margin. The market is not a survey of what everyone believes. It is an auction that clears at the point where the final buyer still says yes. So when foreign central banks pull back, that does not merely subtract one line item from a spreadsheet. It forces the question of replacement. Who fills the gap? Private investors, domestic institutions, the Federal Reserve by one route or another. Every answer has a cost. If private buyers fill the gap, they will demand yield. If domestic institutions fill the gap, they may crowd out other uses of capital. If the Federal Reserve eventually becomes the buyer in a more explicit way, then the currency absorbs the pressure. That is what makes this moment so important. The pain does not disappear, it moves. And once you understand that, you stop looking for painless solutions. I want to name the mechanisms clearly, because unnamed danger always feels vague. Named danger can be handled. The first mechanism is the reserve drain. Oil shocks do something brutally simple to importing countries. They force an urgent need for dollars. If you import energy and the price spikes while your currency weakens, you have to get dollars somewhere. Selling reserve assets is one way to do that. Treasury holdings become a source of emergency fuel. The second mechanism is the refinancing wall. You can live with a heavy debt load for longer than people think if rates are low and maturities are long. But when huge amounts of debt have to be refinanced in a shorter window, the mathematics harden. What was once a slow burden becomes a near-term stress test. The wall is not the existence of the debt. The wall is the timing of the rollover. The third mechanism is the credibility discount. America has lived for a long time on a premium that was easy to take for granted. Deep markets, rule of law, reserve currency status, military strength, institutional weight, all of that still matters. But credibility is not a museum piece. It has to be renewed. If the fiscal path looks reckless and monetary choices begin to appear politically bent, the market starts asking for a discount to be paid back in yield. Not because the United States vanishes tomorrow, but because confidence loses some of its old purity. The fourth mechanism is the interest spiral. This is the one that destroys people because it feels boring right until it begins to dominate everything. Every point of higher refinancing costs means more annual interest expense. More expense means more borrowing means more supply means the next auction requires stronger demand or higher yields. The machine feeds itself. The fifth mechanism is the safe haven fracture. There was a time when geopolitical stress almost automatically strengthened the old reflex. Buy treasuries, hide in dollar paper. But if the crisis itself causes reserve sellers to liquidate treasuries, and if the market begins worrying about U.S. fiscal capacity at the same time, then the old safe haven reflex no longer works cleanly. The haven starts carrying visible weight. Once you see those five mechanisms together, you can finally understand why this is not just another macro headline to forget by next Tuesday. It is a system story, and system stories always matter more than price stories. When I see a market near highs and people feel reassured because the index looks fine, I get more cautious, not less. Surface calm often appears precisely when the stress is migrating underneath. In every serious break I have lived through, the public kept staring at the most flattering numbers for too long. They watched the stock chart. They watched a handful of famous names. They listened to officials reassure them that the system was resilient. Meanwhile, the real story was somewhere else. In one era, it was commercial real estate. In another, it was subprime. In another, it was leverage hidden inside vehicles nobody bothered to understand until forced selling made them understand very quickly. This time it is sovereign refinancing pressure colliding with a less obedient buyer base. That does not mean tomorrow morning brings catastrophe. It means the room is rearranging itself in a way that punishes complacency. I want to tell you where most people go wrong next. They think the right response is either panic or denial. Panic says sell everything, hide, wait for the all clear. Denial says America always finds a way. The debt has always been there. The market always climbs a wall of worry. Buy the dip and stop overthinking. Those are the two lazy responses. A serious investor does something harder. He stops worshiping simple slogans and starts reading balance sheet reality. I do not need to tell you that America is not going to disappear. That is childish. But I also refuse to tell you that because the country survives, every asset denominated in its paper will behave the same way it did in the most comfortable decades of the past cycle. That is equally childish. What changes first in an environment like this is not survival. It is pricing. Assets do not need civilization to collapse in order to disappoint you for a decade. That is a lesson people only seem to learn after paying tuition. So let me tell you how I would think if this were my money and I had to live inside the next 5 to 10 years rather than merely comment on them. I would begin with identity. Most people think of themselves as stock investors because that is what the culture trained them to be. But when the refinancing pressure of a sovereign becomes one of the main moving parts of the world, I stop thinking like a stock investor and start thinking like a balance sheet investor. That is the identity flip. A stock investor asks, what will go up? A balance sheet investor asks, what survives if the funding cost of the system itself keeps rising? That question changes your whole posture. You begin caring less about story stocks and more about who has hard cash flow, low leverage, and the ability to keep selling what people need. You care less about glamorous duration and more about short maturity optionality. You care less about index worship and more about concentration risk hidden inside supposedly passive products. You begin to appreciate cash, not as dead money, but as uncommitted power. You begin to appreciate gold not as a cult object, but as a political neutrality asset. You begin to appreciate the difference between nominal safety and real safety. That last distinction is one of the most important in all of finance. Nominal safety means your statement still shows the number you expected. Real safety means your purchasing power still exists after the system has adjusted. A person who earns 5% in cash while the currency and asset regime quietly shifts beneath him may feel wise for a while and still end poorer in real terms than someone who understood where the true stress would land. That is why I never let myself be seduced by yield alone. Yield is a number, structure is a judgment. This is where the playbook has to become practical, because philosophy without action is just decoration. My first rule would be this: shorten what can be shortened. If your money is in long duration promises, you are making a large bet that the market will remain willing to finance the American state cheaply enough, long enough, and peacefully enough for those promises to behave. That may still work from moment to moment, but the risk is plainly asymmetric. I would rather have liquidity and short maturity than spend my life defending why a long bond still belongs in a world that keeps demanding a bigger term premium. My second rule would be this: reduce concentration hidden under respectability. A great many people think they are diversified because they own an index. In reality, they are concentrated in a handful of giant companies at valuations that only make full sense. If liquidity remains friendly, rates calm down, and macro pressure does not keep spreading into the discount rate. Some of those businesses are magnificent. I would own some of them at the right price. But great business and safe position are not synonyms. My third rule would be this: own some neutrality. In every era, people laugh at gold right until confidence in paper begins asking more from them emotionally than they can easily give. Gold is not magic. Gold does not produce cash flow. Gold is not a business, but it is also not someone else's liability. In a world where the buyer at the Treasury auction matters more and more, an asset that sits outside the promise structure deserves respect. My fourth rule would be this: favor pricing power over narrative. If I am going to own businesses in a world drifting toward higher financing stress, I want companies that can pass through costs, carry light debt relative to their earning power, and sell things customers keep buying regardless of mood. That means less romance and more necessity. Healthcare, consumer staples, selected energy exposure, parts of infrastructure, the kinds of businesses people keep using while pundits argue about which regime we are in. My fifth rule would be this: keep dry powder and a written trigger list. I do not believe in heroic improvisation during a panic. People imagine they will be brave at the right time. Most are not. Most become philosophers of caution exactly when prices are best. If you want to behave well in the next phase, you need rules. Now, what yield level on the 10-year makes you more defensive? What kind of failed auction changes your view? What spread widening tells you the market is no longer coping? What signs of renewed explicit intervention make you start buying again? Write it down before emotion enters the room. That is what separates prepared capital from opinion capital. Opinion capital talks. Prepared capital moves. You might ask me whether this is bearish. That is the wrong question. I am not interested in labels. I am interested in being paid correctly for the risk I assume. There are times when the right response to a changing world is aggression. There are times when it is patience. There are times when the best asset in the room is optionality itself. If I have learned anything over the decades, it is that temperament matters more than cleverness once the regime changes. A man who needs excitement from markets will almost certainly be ruined by a period like this. A man who needs certainty will also be ruined. The people who do best are the ones who can live inside ambiguity without handing their judgment over to it. That is what I want for you. Not fear, not false confidence, clear-eyed patience. I want you to understand the deeper danger here if the rest of the world becomes less willing to fund American deficits on the old easy terms. The United States still has power, enormous power, but the menu of solutions changes character. The country can accept higher rates and the fiscal pain that comes with them. It can lean more heavily on central bank accommodation by one name or another. It can tolerate more inflation over time. It can pressure domestic institutions. It can do several of these at once. What it cannot do is make arithmetic vanish. That is the lesson of every debt story ever written. Empires do not die because numbers exist. They weaken because they insist numbers do not matter until the numbers begin governing every decision. I am not telling you the end is here. I am telling you discipline is now expensive to postpone. There is a line from business I have always loved because it applies to nations as much as companies. The chain only breaks at its weakest link in finance. The weakest link is usually the funding assumption. Nobody bothered to stress for years. The assumption was simple. There will always be buyers for treasuries because there always have been. That is not a risk model. That is nostalgia masquerading as analysis. When I see a $38 or $39 trillion debt pile, more than $10 trillion to refinance across a compressed window, foreign official holders cutting exposure, auctions demanding more concession, and interest cost already eating the future faster than the public appreciates, I do not shrug and say the old assumptions are probably good enough. I lean in, I ask what kind of world that produces if it continues. And the answer is not a world in which the old portfolio built for disinflation and easy money is automatically your friend. The answer is a world in which structure matters again. That is the phrase I want to leave you with. Structure matters again. The legal structure of your claims, the maturity structure of your assets, the financing structure of the businesses you own, the reserve structure of the world, the spending structure of the sovereign behind the currency. For a long time, people got away with not thinking about structure because liquidity covered a multitude of sins. That kindness is fading. The bond market is beginning to ask tougher questions. Whenever that happens, I stop trying to win arguments and start trying to survive and compound. That means humility. It means shortening my reach. It means wanting assets that do not need a perfect macro backdrop in order to justify my owning them. It means accepting that what made money in the last phase may not protect me in the next one. Most people only change after pain makes them. A few change while the evidence is still enough. That is the real dividing line. Not rich versus poor, not smart versus foolish, prepared versus unprepared. If you walk away with one thing from this, let it be this. America's problem is not merely that it owes too much. America's problem is that the buyer at the auction is becoming more selective at precisely the moment the refinancing need is becoming more urgent. That is where the whole machine begins to creak. And once the machine creaks, every comfortable assumption inside conventional portfolio thinking deserves to be re-examined. I have seen too many people hand their future over to habits built for a different cycle. Do not do that. Read the auction room, read the bid, read the buyer, then decide what kind of portfolio belongs in a world where the old easy demand is no longer something you can blindly count on. That is how you keep your freedom. While other people are still arguing about whether the warning light is real,